Should I get a loan for real estate? Isn't debt bad? Great question. This is something that I struggled with when I first started in real estate. I had spent many years paying off bad debt. Many years paying off bad debt. So I came out of college with 65,000 in student loans, had a $2,500 wedding ring, $25,000 truck, $15,000 in credit cards. So here I am at 22, 23 years old with over $100,000 in debt behind the eight ball, where many people start. It's not a fun place to be. And so from 2013 to 2018, my wife and I cut our expenses in our budget, lived very frugal, and paid pretty much everything outside of our necessities into paying off debt using the debt snowball, paying our smallest debt, then our next largest, our next largest, next largest, next largest, until we got all our debt off. And today I owe nobody nothing. That's too negative. That's a double negative. I don't owe anybody anything when it comes to debt, bad debt. So let me explain what's good debt, what's bad debt. Bad debt is consumer debt. It is debt on a disposable product or a depreciating product or asset. I don't know, it wouldn't even be called an asset if it was depreciating, but well, for lack of better terms, we'll call it on a depreciating asset. So bad debt would be something like student loan debt, which one could argue that, if you are able to make more money because of your debt at student loans, it's not the worst debt in the world. Great. We can have an argument about that. But you can look at vehicle debt. Vehicles are going down in value. Credit card debt, store cars, payday loans, all of that type of debt is terrible, terrible debt. Good debt is when it's backed by a cash flowing, appreciating asset like real estate. Okay. And it took me a long time to break through mentally and feel okay to buy real estate using debt, because I just spent 5 years paying off of debt. But they're two totally different things, consumer debt and real estate debt. Okay. And so when we use debt for real estate, it is going to be long-term stable debt, usually in the real estate investing world, anywhere from a 20 to 25, well, really 20 to 30-year amortization schedule. Oftentimes, you're going to have a fixed rate, okay? And you've ran your numbers in pro forma on the front end to know that the cash that you have coming in from your tenants through rent is enough to at least cover your mortgage and expenses. Now, I told you a story about me earlier, how when I first bought my Airbnb, I didn't care if I had to pay $200 to $300 into it because I knew it was such a good piece of real estate. I don't recommend everybody doing that. I had a lot of income coming in at the time. If you have a lot of income coming in at the time and you can afford to do that, great. But for the majority of us, if you're going to use debt on real estate, you're going to want it to at least break even, and ideally you want it to cash flow every month. So when after the tenants pay you rent and you pay your mortgage, taxes, insurance, maintenance, vacancy, capital expenditures, property managers, you still have money left over. Okay? That is good debt. Why? Here's why. Because we are able to come up with a very little amount of capital, or if you, by the way, I teach no capital at all, then somebody else is going to give us the money to buy the property. Okay. So we're going to get into a deal, whether we're using 20% down or we have zero money in the deal. Okay. And then we're going to get a tenant in place and they're going to pay that debt off for us. So you can control a very expensive asset like real estate worth, $200, $300, $400,000, $1 million, $2 million, have none of your own capital in the deal or very little amount of capital in the deal. And then you get a renter in place and they're going to pay all of that debt off for you while the property goes up in value. So you've bought it, you got a little bit of equity when you started buying, like when you bought it originally. Now it's going up in value. So your equity is increasing on the top end. And then your tenants are paying down your mortgage. So your equity is increasing on the low end. That spread creates your net worth. And so you may buy a property at day one that's worth $200,000 and you got $150,000 in it. So that leaves you with $50,000 in equity. Well, after year 5, that property's worth $250,000 and there's only $100,000 mortgage on the note. And that leaves you with a net worth on that particular property of $150K. So you started with $50,000. Now that spreads $150,000. Well, that increased your net worth. You do that 10 times, you're worth $1.5 million. Why do you think so many millionaires are created through real estate? It's because you can leverage and use debt, use other people's money to buy it while it goes up in value and tenants pay off your debt. It's literally the biggest cheat code known to man. I preach this all the time. There's 6 main pillars in real estate, and I call them the greatest financial concoction on the man when they're all put together. You got leverage, you got forced appreciation, which is you can buy something ugly, make it pretty, and it's worth more instantly. You got traditional appreciation, just means the real estate goes up in value over time. You got cash flow, which means you got money coming in your pocket every month. You got number 5, tenants are paying down the debt that you use to buy the property. And number 6, you get all these tax benefits. You can do cash out refis. You can do home equity lines of credit, never pay any taxes on either of those. They're not taxed. You can do 1031 exchanges, take one property, upgrade into another property, defer your taxes. You could do accelerated depreciation. Usually you depreciate a property depending on what type of property, but residential over 27 and a half years. Well, there's loopholes to allow you to do the majority of it in 1 year. So you can get all the money that you put into the deal, if you had to put a large payment down, back through tax benefit. I mean, the sky is endless. The opportunities, the sky's the limit, and the opportunities are endless when we get into this game. And so we can't let debt hold us back, and we get to write off the interest that we put on the debt. So debt is a very, very powerful tool if used strategically and used correctly. Where people get in trouble with debt, even on real estate, is when they start doing dumb loans. So people will go and they'll do a 60-day or 90-day high interest loan to get a flip done or get a project done. And then that 60 or 90 days comes up and they're not completed with the project that they were doing. And now that loan comes due and they don't have the capital. That's where people get in trouble. I personally don't have any real estate debt that's any shorter than 1 year. So all of my rental properties are on 20 to 30 year mortgages. Okay. So they're set, they're solid, they'll be paid off. And then when I do flips, if I use debt for flips, then the loan that the person gives me is good for an entire year. So it's a 365-day loan. It's usually going to be higher interest, around 12%, call it. And that can vary depending on the market, but it gives me an entire year. And I know that my average flip takes 3 to 6 months. And so I'm giving myself a huge buffer here. And the long end, I'm usually 6 months. A lot of times I'm 3 to 4 months, but then I give myself another 6 months buffer in case the project goes long. And then I can pay them back early and there's no penalty, but you have to protect yourself. Where people get in trouble with debt is they get greedy and they get risky. Listen, your goal in real estate is there's going to be upside. Real estate inherently has an upside built into it, especially you look at the U.S. now printing all this money. We've been printing money for a long time. The dollar is going to continue losing value. Real assets are just going to continue to go. They're going to continue to go up in value over time. And so we got to trust ourselves to get into this. You have to do it for your future self. It's going to absolutely change your life. And, don't let the fear of what could happen. Don't let the fear of what could happen deter you. And what I was going to say is we know real estate is going to go up in value. We have to mitigate the risk. Good investors over the long term mitigate risk, okay? Because you're going to get the W because of real estate. But we have to keep ourselves in check. And how do we lower the downside as much as possible? You do that by securing good long debt that serves you well, and don't get greedy with the short-term debt, and you'll protect yourself. Guys, if you haven't already, snag my free ebook. You can click the QR code. You can scan the QR code if you're watching live or if you're watching on YouTube, or if you're listening on the podcast, go down to the show notes, snag the free ebook on how to buy your first or next investment property. It's going to give you step-by-step guide on how to do it. If you guys don't have a property and you're trying to get started, great. It's going to show you what to do. Or if you have a few properties and you're having trouble scaling, it's going to break that down for you. Hey, thank you for tuning in this week. Sorry I missed the last couple weeks. I was traveling, but I'm glad to be back with you guys. Absolutely appreciate each of you.